The Firm, India's only show on corporate law, tax and audit matters.
In 2009, when the draft direct tax code was released, Revenue Officer Arbind Modi said of the 4.5 lakh companies in the country, only 50,000 companies pay taxes, even though the remaining 4 lakh companies held a large volume of resources or assets. Fast forward to 2015. Of the 5,64,787 companies that file taxes, 45% don't make any profits. And though the statutory tax rate is between 32 to 34%, the remaining 55% that do make profits pay an average effective tax rate of 23%. Now that's thanks to a variety of tax deductions and exemptions. Together, these deductions and exemptions cost India 62,000 crore rupees net of MAT. The biggest of these deductions and exemptions is accelerated depreciation. It costs the exchequer 37,000 crore rupees. The deduction of export profits in SEZs amounts to over 18,000 crores. Deductions for the power industry amount to 10,000 crores. And deductions for scientific research add up to 8,000 crore rupees. Now the government has proposed to do away with all deductions and exemptions starting FY18. Alongside, it will reduce the corporate tax rate to 25% over the next 3 to 4 years. Hello and welcome to this special edition of The Firm. Should India Inc. give up all tax deductions and exemptions in exchange for a 25% corporate tax rate? Well, joining me to answer that question on this edition of The Firm, Ramesh Swaminathan, the CFO of Lupin, Praveen Sood, the CFO of HCC. During the show, you will also hear from Suresh Senapati, the former CFO at Wipro, and V.S. Parthasarathy, the Group CFO at M&M. Also with me is Pranav Saitha, tax partner at EY. Gentlemen, to all of you, a warm welcome. I'm sure you are all going to say this is directionally a great move.
Absolutely.
So I'll preempt the political correctness and come straight to the issue of 25% as the flat corporate tax rate that the finance minister would like to levy, whether next year, 2 years, 3 years, or in 4 years as he has laid out. Is that a good enough tax rate, Mr. Swaminathan? Because today, companies pay on average an effective tax rate of 23%.
Absolutely. That's a question that I have. Why not 23 itself? If the effective tax rate for corporate India is 23%, then I think the headline number should be 23 and not 25. And there again, he has not actually spelled out the pathway really, because today the effective tax rate, the marginal tax rate is actually 34.61%. That's 30% plus surcharge, plus there is educational cess of about 3%. It all accumulates to about 34.61%. So if he is going to bring it down from 34.61 to 25, he has not laid down the pathway. Is this actually a reduction from 30 to 25, or is he saying that on top of it there will be a host of other levies as well? He's silent on that.
I agree with you, but I mean, why are you surprised for this? Because you just have seen that same thing happen in the case of service tax also. They says, I will remove everything from 12% service tax. There were some levies and all those things. Effective rate was about 13.6. Now they came with 14% rate. You paid more. And after 6 months waiting that you are not resisting, they made another Swachh Bharat Abhiyan, this is BT tax of 0.5%, 14.5%. So this is what I think government is going to do, because
so you're saying you don't believe the numbers.
I don't
even if they're saying
numbers,
25%, it's not going to be 25%, it's going to be 25%
exactly,
with 5 other
it's 25% plus basically. And I think these two taxes, 12% surcharge and 3% cess, I think when Mr. Jaitley made this statement, I think he was meaning that 25% in lieu of 30%, and then on top of it whatever taxes are there. Although we had a promise from Mr. Chidambaram that this surcharge will go in 2 year period, but I don't think it's gone. So, and I don't think it's going to go away so easily. So that's my problem, is that you promised me a single rate. I mean, you can't keep on adding and loading.
Okay, suppose they promise you a single rate. Is 25% good enough?
I'm very happy with that.
Even though effectively most companies are paying 23% today, so for them it will be an increase
of 2%. I would like to give them a benefit of basically 2% as long as they make a promise that they will not be increasing the rate to 25% plus in the next 2 or 3 years. Okay,
Pranav, where does 25% stack up, let's say, with other countries? Whether you look at the developed world, UK, USA, you look at the emerging world, China, Brazil, is 25% a competitive headline rate with no further surcharges? So we're assuming 25% will subsume all the surcharges.
Right. So let's assume 25% is all-inclusive That tax rate is the totality of the tax rate for corporate India. If that's the tax rate, I think we are just about competitive with many countries.
Okay.
If we look at China, we look at Indonesia, we look at Malaysia, we look at UK. UK is in fact much lower. Some of the countries like Singapore, Hong Kong, Taiwan, UK would be much lower, 20% or less. They are all between 16 to 20%. US, of course, is much higher. But otherwise, about 35+%, plus they have state tax. So US is extremely high in terms of tax rates. But other than that, if we look at most of the countries with which we compete, which are these ones, even South Africa I think is around 28%. So most of the countries, China, Indonesia, Malaysia, Taiwan, South Korea, all of them are, Taiwan aside, all of them are 25. Taiwan, Singapore, Hong Kong around 16, 17. UK is 20 but going down to 18. So most of these countries have a very, very low tax rate. 25 is just about at the margins of competitiveness, but if it's all inclusive. And so far as 23 is concerned, I would be okay with 25 for the simple reason that the 23 that we are talking about, I believe, is an effective tax rate based on the profits as per the books of companies.
Okay.
But accelerated depreciation is not completely going away with all of these exemptions and incentives going. Depreciation to a large extent is still going to be an incentive so far as the corporate sector is concerned from a tax standpoint. And therefore there will be still some arbitrage between the 25% headline corporate tax rate and the effective tax rate when one looks at book profits, because the book depreciation might still be below the depreciation allowable for tax purposes, depreciation plus investment allowance and so on. So I still feel even if the corporate tax rate was 25, the overall ETR will be below 23 probably for India Inc. as a whole. So I would be happy with 25, but an all-inclusive 25.
All right, that's about the headline tax rate of 25%. Now we want to talk about the individual exemptions that are being taken away and the industries that will be impacted, but we'll do that right after this quick break. Accelerated depreciation is really the biggest component when you look at what all these incentives and deductions and exemptions cost us, right? So I think the number I put up is it costs us roughly 37,000 crore rupees, but all of it is not going away. Some part of it is still staying. Please explain that to us, because the impact of this is across industries. It's not specific to any one industry.
Oh, absolutely. So what the paper seems to suggest is that wherever the depreciation rate is above 60%, they'll probably bring it down to 60%.
So either 180
now those are very, very
60.
few instances. So pollution control equipment, plus energy saving and renewable energy. These are the 3-4 spaces where the depreciation rate is. So that's where it is above 60%. Those will come down. But otherwise, by and large, the fact that we have a 25% depreciation rate generally on plant machinery, on intangibles, the fact that we have probably investment allowances in many cases, if those stay, I think those are big benefits that still stay, and therefore a 25% rate I think is good if it is all inclusive. I am assuming here that MAT automatically goes as a natural corollary of all this, and therefore there is
it has to, right? Because it came into being simply to tax those companies that were not showing any taxable profits thanks to incentives, etc. So, if those incentives go away, is it not logical that MAT will go away? Is it really a talking point?
But to your point of has to, I would say it ought to, but I would rather make it very transparent that it is indeed
but logically it ought to.
Yes,
it ought to. It ought to, because and if you look at the growth of this tax from 7.5% MAT, suddenly it jumped out to 15% and 15% to straight away 22% today. 22% and 25%, there is hardly a difference. So it looks very odd that you are charging a MAT of 22% and suddenly you are charging me the flat tax rate of 25%. It has to go.
Okay, fine, fair enough. Okay, so accelerated depreciation benefits several industries. Some of that benefit will go away, as Pranav has just explained. Besides that, the key other industries that get impacted when incentives are taken away are those industries that invest in research and technology, for instance, the pharmaceutical industry or the automobile industry. Then we've got infrastructure, which has several profit-linked tax deductions. And then the biggest other slice of them all is SEZs, again, profit-linked incentives. So we'll tackle each one of them on their own. What's your position, Mr. Swaminathan, on the doing away with some part of the weighted deduction on R&D?
If you look at it at first sight, it says that, the tax rate is going to be brought down to 25, but you're also going to, in fact, phase out, in fact, the whole of exemptions.
Yes.
So potentially, it looks as though it's a fair game. But I would not really agree there. Let me talk about quite a few points. Firstly, if your R&D as a percentage of, in fact, your PBT is high, in my opinion, in fact, if it is higher than 16.5%, then you are actually standing to lose out. And with this math in respect to our profits for the current year, or looking at, in fact, the profits of the past year as well. So my indifference point is actually, if my R&D expenditure is in excess of a particular limit, then I'm actually going to lose out. So to the extent,
even if the tax rate all inclusive comes down to 25%.
For sure. So
okay. And your current effective tax rate that you're paying is roughly 24%. You pointed
It's about 24%. That's correct. So that's the first thing. Secondly, R&D in its wake is, because of its very nature, it actually involves a lot of uncertainty. So we are talking about, we're battling a lot of uncertainties, battling on the scientific uncertainty on the technical front, because you really don't know whether you have the technology to get there. On the regulatory front, because you might actually make a submission, but it's quite possible that the regulators don't agree that you've actually got a product. And lastly, on the market front itself, so there are a lot of uncertainties. So there are a lot of risk associated with that.
What business doesn't have risk, Mr.
For sure, but that's R&D by its very nature is risky, right?
When we get to Mr. Sood, we'll tell you being able to get right of way to build a road is in itself as risky as being able to create a patentable product.
I don't deny that, but that's the risk that you actually have because of the fact that you've got competition, a host of things. I'm speaking about my industry, and there's a lot of uncertainty there when it comes to R&D itself because of the nature of R&D. You might blow $1 billion, but at the end of it, you might not really have anything in terms of outcomes. Given the fact that there is so much of uncertainty, I would think that there has to be an incentive for actually performing that particular function. And let's take the example, in fact, of other countries. There is, in fact, an incentive for looking at there is R&D grants being given, and for sure, in most countries, there's something known as the patent box regime as well. For example, let's talk about UK. If you have profits coming out of, in fact, income streams coming out of, in fact, innovation of patented products, then you are actually talking about a tax rate of not more than 10%. And this is something which has been done in Netherlands, the UK, the US
would
is
you not
looking at
draw
it.
a distinction between the profit that you make from a patent or a patented product or a patent embedded in a product and getting a tax break on that? In this case, you're getting a weighted deduction just for spending money with no outcome mileposts.
That's exactly the point, because I'm bearing that risk and I need to be incentivized for that. Look at the number of patents that have actually come out of India. It's abysmal.
Despite the fact that there has been so many...
I'm saying it is also because the fact that there has been not too many incentives for people to put more money into research.
I've never heard an inventor say, I invented this because I got a tax break. So
it's not. I'm saying that the fact of the matter is tax breaks are given in several countries.
To be fair, an R&D incentive or credit is available in many countries. So if you look at BRICS, all the others, China,
Russia,
South Africa, Russia, Brazil, all of them have R&D benefits, weighted deductions. I think most of them have 150%.
But some part of the weighted deduction, but even some part of the weighted deduction is staying, right? It's only
it's gone.
No, from 200% it's going to go to 100% or something like that.
No, that's basically, you're saying that the whatever amount is deductible. That's all. You're spending 100, you get 100.
So what you're getting is an accelerated depreciation, effectively. Because the entire capex is being allowed in year one. It's like so essentially most of these have 150% weighted deduction, the BRICS, as I said. Then there are countries which really have a profit-based incentive for R&D.
The patent box regimes
that Mr. Swaminathan spoke about. So UK has it, which levies only a 10% tax. US is actively considering it. Something has been introduced in the House there as well. Netherlands, I think, has it. So there are many countries which have regimes which give a very, very concessional tax rate to profits from R&D. Now, are these countries already having a very competitive tax rate? We've seen already the tax rate in the BRICS. We've seen the tax rate in UK.
And a very pertinent point here at this stage, even when you are talking about this, the new OECD principles that are going to apply, they are not actually talking about actually phasing out of the patent box regime. They are saying that
the BEPS principles that you're referring
to. The BEPS principles, absolutely. The BEPS principles actually recognize that. So it's not actually, it's going to be taken out when a new regime comes in at some point of time.
So the point I was making is, despite having a competitive tax rate of 25% or less, they still have these incentives for R&D. Can
So
India
you're
afford it?
clearly batting in favor of this incentive to stay.
Not necessarily. What I'm saying is India has to make an assessment of what is the need of the hour for the country as of now.
I'm going to hear that about
There
half
are-
a dozen times in this discussion, because
there
every
are-
industry is saying that.
There are 5 areas. Does India need to incentivize infrastructure creation at this point of time?
Yes.
Does India need to ensure
There you go.
that exports are supported
On
and we have
behalf of the
currency
export
earnings?
industry that I've spent 3 days talking to, I'll say yes.
Does India need to
sure.
ensure we
We export.
are
They export as well, yeah.
Does India need to ensure that we are the design and intellectual capital of the world, not only make in India but design in India, innovate in India and so on? Does India
Well,
need
then we
to
should shut
create
this discussion down
jobs?
right now, because essentially what
then
you're
why
saying
are
is
we-
not a single
then what
incentive
are we
should go
So what
away.
I'm trying to say is we have to balance this and say that if corporate tax rate inclusive of surcharge cess is going to come down to 25%, are we willing to create a level playing field for all industries and willing to give up most of these
Okay, one
incentives?
second. Hold that thought. I do want to bring in here V.S. Parthasarathy, the Group CFO of Mahindra & Mahindra. Now, M&M on a standalone basis pays an effective tax rate of approximately 24%. The group itself stands to lose 2 critical incentives, tax incentives, the R&D deductions one for its automotive business and the SEZ exemptions that apply to its IT business, that's Tech Mahindra. Now, Mr. Parthasarathy said directionally this is a good move, but he had a list of conditions that he put down to make it a good move. For instance, he said programs like regional development, like the Make in India program, must continue to get some sort of tax support. He had other conditions as well. Here they are.
First is, please be very clear about what is your max tax rate. That means if 25 is all up all in, our 25 is going to be 25 plus something. So one of the requests I would put it that if you are coming to the new rate of 25% should be all up all in tax rate going forward. Okay. The second one is not look at any industry specific but focus on 2 things. One is what is the inclusive agenda or regional development areas. For example, take some time back Rudrapur, it gave a tax incentive for people to set up industry there. Everyone knows it's very difficult to set up industry in a new place, and not all logistic and ecosystem exist. But by giving this kind of incentive, today Rudrapur may be a thriving hub. So similarly, if locations needs inclusive growth and regional development, that must be supported. And that is not one industry or the other, across industry. Similarly, Make in India is something that they should say. And when I talk about Make in India, I am only saying look at what countries, emerging countries are doing, and therefore we must make India a more attractive place than its other competitive markets for manufacturing. The third one I would say is abolish MAT then, because if you are already bringing down the tax rate to 25 and also reducing most of the deductions, then why have another concept called MAT? And if depreciation is the only difference, tax also can adopt the accounting depreciation, and in which case there will be no difference, and therefore don't have another concept called MAT. The fourth one I would say is DDT, dividend distribution tax. The dividend distribution tax is a double taxation. Please take them away. And the fifth one is in terms of CSR. CSR expenses is as much a business expense today to take care of the society in which they operate. I mean, you could take them as expense equal to an employee expense, employees for employees, and CSR is for the society. Or you can take as both as investment. In both cases, there is a case for 100% deduction for CSR, which should be considered. And if we take all of them together, otherwise what will happen is CSR with 2% effective rate is not 25 but 27. So if these 5 things are taken care, I am not very specifically looking at saying auto industry should be given something, but at the same time I would only mention that R&D is an important element for India to come in as a developer and manufacturer, not just a manufacturer but also having the IP ecosystem in India. So that's what I'm asking.
I love the answer because it says this is directionally great as long as you do away with DDT, full deductibility for CSR spends, keep incentives for regional development, keep incentives for Make in India, keep incentives for R&D, Mr. Swaminathan, and then I'm good with all of this. Essentially, which means don't change anything in my life, just bring the tax rate down to 25%, right?
We're living in utopia.
No, so even the auto industry is making the same point as you are. Don't take away the R&D incentive whatsoever. Now, one of your compatriots said on CNBC TV 18, Kiran Mazumdar-Shaw, that if this happens, that many industries or many companies rather in the space will have to consider moving their IP activity outside India. Is that really going to effectively happen? What happens if this does go through?
Well, I hope that was as simple as that. I don't think it's possible. It can't move it, and it's not a shut-on, shut-off kind of operation.
Is that your fear as well for
I would feel it's easier said than done.
Industries?
I would feel it's easier said than done. It's not very easy to move an entire head and brain of the research and development.
And it's going to get less and less easier with BEPS coming in, right?
Absolutely. And the BEPS principles are very clear. It's substance-based. It's going to be extremely difficult. Finally, I think it's going to boil down to where you have the resources and the infrastructure to carry out that research and to succeed. So I think it will stay. I'm not so worried that it will fly away.
So bottom line impact?
Yes, there would be a bottom line impact.
For sure. And in our case, it's certainly going up. I would say at least about a couple of percentage points in terms of...
a couple of percentage points?
Yes.
Okay, fine. Well, if the very profitable pharmaceutical industry says we need incentives to invest in R&D, imagine how the infrastructure industry, the loss-making infrastructure industry, is reacting to the doing away of profit-linked incentives. We'll discuss that right after this quick break.
The Firm, India's only show on corporate law, tax and audit matters.
Let's now shift our attention to the infrastructure industry. That is also set to lose all its profit-linked incentives starting April 1st, from what I understand. A wide variety of infrastructure industries gets impacted. Power, which the sunset date for which is being brought forward to April 1st, 2017, also gets impacted in a big way. Can you describe to us what happens to the industry? What are the key exemptions that are going away?
See, the biggest exemption available to infra industry is 80IA. It's a benefit which is being given to develop certain kind of infrastructure enterprises. Basically, it talks of the BOT roads, it talks of the roads, highways,
so
it talks of townships.
All
it
profits
basically give you a tax holiday of 10 years period.
Where you don't pay any tax on the profit.
Any taxes.
Any 10 years of the project you can
you can pick up, and you will not pay any taxes on that. And again, there's a twist to this entire story, because this tax was basically introduced. This exemption was got somewhere into, if I'm not wrong, around 70s 80IA, and in 1997 they revised it, and then I think in 2009 from retrospective date they big amendment, and they says the construction companies or the subcontracting companies will not be getting this benefit. This benefit was being taken by the companies who were intermediaries into the development of these businesses, like construction companies.
So both the developer, the person who owned the road, as well as the company that was constructing the road, both of them got a tax holiday of 10 years on all profits, 10 years of their choice during the life of the project.
As long as, like in case of a construction company, it was different, because we were doing the business, doing the construction for that period. So whatever work we used to do for that, we can always claim an exemption on those income which we earn from doing these projects. So that was the intention, and that we were claiming. After this circular of 2009, entire thing went for litigations.
So will you weep too much if the incentive goes away?
We will not weep too much, because right now the entire industry is passing through a phase where it's not making a profitability at any point of time. Every company in the infrastructure sector is carry forward losses and all those things, and it's not getting, to be honest, a tax. Most of them are under MAT. We are paying MAT taxation, because all our profitability is coming from the various account of claims which are not getting basically paid to us, and as per the system what we follow is that on the claims amount normally we don't pay taxes because it's on accrual basis.
So you see no impact on, let's say, HCC or the other companies that work in the contracting business as of now, if this incentive were taken away? No collateral impact from the impact on those that are developing infrastructure either?
No. Let me clarify it very clearly. The companies who are into the development business, even SCC, a part of it is into the development business.
Yes, because you do own some roads.
SCC infrastructure, basically, which do the infrastructure development. There would be impact. There would be impact, because
Can
suddenly
you
will
quantify it for us from a bottom
very
line
difficult to
impact point of
quantify,
view?
very difficult to quantify, because at this point of time you have again carry forward losses and everything. But on a going concern, normally you get tax 10-year holiday, so you pay zero tax.
For 10 years.
You pay only MAT. And that again under litigation, because there was a concept going on that if everything is exempt from me for 10-year period, how can I supposed to pay MAT? So again, there's some circular which came subsequently saying, no, you are supposed to pay MAT on that.
So aren't you happy that all of this confusion will go away?
That's why I'm simply saying I would be happier, but again, I'm not very sure about the companies who are in development business, because if we talk of R&D and everybody make a story that okay, R&D is essential for the development of this new patent and everything and all those things, same argument stands true here of infrastructure, because in this country infrastructure is deficit, no doubt about it. I'm very sure everybody across the table will agree for that. And if you want to build infrastructure currently at this point of time, you have no option but to incentivize the people normally who are going for the infrastructure development. As it is, we have seen that because of the various environment around us in the sector, most of the companies are unable to carry it out as per the desired speed or desired time level. So most of them are incurring losses and getting into all sort of problems. This sector is passing through, I think, a crisis period at this point of time.
I love the way you answered my question, Mr. Sood. You've said I'm all in favor of doing away with all incentives, but this is not the time to do it.
Yeah, I mean, you just can't start with the okay, infrastructure sector, whatever we have given, I will take away everything. 10-year period has to continue for future.
But they are grandfathering this.
So long as you complete and you commence your project
before April 1st, 2017.
Absolutely, by 31.
You will still enjoy the 10-year holiday.
Absolutely.
Yeah, but all the projects thereafter,
all
there's
the
a port or an airport or a road.
Yeah.
And are you sure they will not bring out some retrospective change in the law?
Well, I hope not.
Or previous projects also don't get
projects also, because this is the problem.
Okay, why be suspicious? They're trying to clean up things, so why be suspicious?
I think they have sort of made the intention very clear that they'll grandfather all prior projects.
Yeah, that's,
the continue with the exemption for the remaining part of the 10-year period.
With clear knowledge in the beginning, I think...
but that's what they're attempting to do, so let's give them brownie points for that.
I think the matter is, the finance minister is going to find it pretty difficult to balance the books. So if, if all of these wishes are going to turn true, the fact is, we're not going to be able to afford it.
I like that you're saying that, because that's exactly the point here. You said R&D must stay, he says infrastructure must stay.
I think the answer really is in actually making sure that there is better compliance, perhaps in broadening the tax base and measures of that kind.
That too must be done, but that can't be the only area of thrust. Let me tell you what the power industry guys told me, and I was talking to a few companies through the course of this week, and they said, okay, you take away our incentives, it will be detrimental, we don't understand what this government is up to. On the one hand, it says it wants to revive power, which is in deep trouble right now, and then on the other hand, it says, it wants to bring the sunset date forward to April 1st, 2017. It's fine with us. If we take the hit, we'll pass it on in power tariffs, and if we pass it on in power tariffs, the cost of consumption of infrastructure, such as power, goes up for consumers. Now, that's your problem, not my problem. How do you respond to this from industry? Is this just knee-jerk, don't twist my arm because then I'll twist yours, or is that the reality we're all going to have to face? If the tax holiday is taken away, the cost of infrastructure becomes more expensive for all of us.
That's a fact which we'll have to face. The fact of the matter is clearly that there are some sectors within the economy that are probably going to have to lose, and there is no doubt about that. Right. At the end of the day, I think what we are trying to say
is... But who's losing here?
Overall,
if the sector's losing and the consumer's paying for higher power tariffs.
For sure.
The consumer's losing at the end of the day, right? The power company is going to do whatever it can to protect its profitability.
Of course. So to some extent, I think it just depends upon, of course, the ability to pass on those extra costs. But the point is that someone in the economy is paying the cost.
Obviously.
But overall, if as an economy we are going to have a simpler tax regime, if we are going to have a less litigious tax regime, something that is more level playing field, and if we are going to have a very, very reasonable competitive tax rate that creates a perception of growth, I think somewhere we have to give it to the finance minister that he needs to balance his books, and there's some pain in certain sectors that will be there.
If you make a case for the infrastructure, if you make a case for the R&D and all those things, in spite of having all these exemptions even right now, are you happy with this, what the way have been progressing? Are you happy with the infrastructure happening in India? So in spite of giving so much of incentive, tax incentive, and then you backward area incentive and all those things.
Then you're proving the finance minister's point that it's not tax incentives that makes you a healthier industry.
Where I'm coming from.
It's a variety of other things that the government would like to tackle.
Precisely. If any business which is based more onto the tax incentive or some kind of a support from outside, some subsidies and all those things, in the long run, I think the moment you withdraw them, I think you will find them limping to become profitable. So I always believe that. I think if you want to run a model in this country, I think from day one, if you tell me very clearly, no support, no tax benefit, everything will be basically
but
as
you
long
just
as you
made
can.
the argument, Mr. Sood, that the infrastructure industry will be crippled if you take away these incentives.
No, I'm simply saying if you take it from the retrospective date. But what I'm trying to say is as long as you are telling me that you can pass on all these costs, extra costs which you are incurring or extra profit which you are giving away, you can pass on to the ultimate consumer, I'm happy with that.
Now, honestly, you might not be left with the consumer.
Why not?
Because there's
infrastructure. I mean, again, let me talk of the infrastructure sector. Basically, roads. Now you are basically making sure that you can't levy a toll charge of more than this amount. You can't do this. You can't do this. You have to leave account government vehicles. You have to do that. You have to do that.
At some point
you
of time,
put too much of conditions on me,
does click in.
but if you allow me to, like
if
in
power
USA,
costs go up, can you afford not to use
That's
power?
not power. Power might be an example.
Can you afford not to use
roads? There's always going
Can
to be
you
an
afford
alternative
not to
route.
use airports in this day and age?
For sure, I agree.
Or
But
ports.
I
mean, what infrastructure is not
it's a
critical?
social good. The fact is, you can't afford to actually get your way when it comes to, because there has to be a curtailment.
airline keep on charging you from 5,000 rupees to 15,000 rupees, 25,000 rupees for the same to and fro daily and all those things, and you still pay 15,000 rupees, you pay 25,000 rupees when you're supposed to go. So everybody pays when it is required, need be there, and as long as you are providing good services.
So you're principally not objecting to the fact that if there is a date from which no new infrastructure projects get any incentives, you're fine with that?
I'm fine
as
with
long
that.
as it doesn't apply to those projects that were designed keeping the tax benefit in mind, and for whom the IRR will now go a little wonky.
Precisely.
Yeah.
Precisely.
So you're
as long
okay
as
with
you are allowing me to pass on the basically entire cost.
And that's the second condition. Allow me to pass this on.
Pass it on. Yeah.
Well, if R&D is critical and infrastructure is critical, are exports any less critical? We'll talk about the impact on export-oriented industries, especially IT, on the other side of this quick break. Let's now come to SEZs. I think about 18,000 crores is what the exchequer gives away to profits made by developing special economic zones and by units located in special economic zones. A variety of industries will get impacted by the doing away of this incentive. IT, big one. Pharmaceuticals, another one. Gems and jewelry, a third one. So many of those industries that work out of SEZs, export-oriented industries, will get impacted by this. Exports too are the crying need of the nation at this point in time. So how would you react to the doing away of the SEZ benefit? You don't seem to be as pained about that as you are about the R&D benefit.
It's more because of the fact that we are actually, our effective tax rate is slightly higher than 20%. So to that extent, I would say that the pain would perhaps be lower when it comes to that. And there's of course going to be, the SEZ benefits are there to stay for a period of time.
10 years. Anyways, SEZs, we knew that there was only going to be a 15-year benefit, right?
Absolutely. So to that extent, we are aware of the fact that there is going to be a sunset at some point of time.
Okay. Well, would you agree with that, Pranav, that in fact, the death knell for SEZ had been rung a long time ago. This, in some sense, is just the final nail in the coffin for SEZs, right? So doing away with the incentives for new SEZs. Again, a grandfathering approach has been maintained here.
Yes.
For new SEZs, okay, is not a really bad thing.
I wouldn't think so. So long as people have had enough time and there's a smooth, planned transition, I think it should be fine. Of course, again, the headline tax rate is 25%. And we must remember that SEZ, we are trying to create pockets of excellence. Several countries have had it. If we have a country where industry is not globally competitive, what we are trying to do is create those pockets, parts of excellence where they can be globally competitive. But there are lots of other incentives in an SEZ which still probably stay. So there are indirect tax benefits, service tax, customs duty, stamp duty, electricity duty, some kind of duty drawback, as we call it, SEIS. So all of those still continue. So I'm not too sure it will be completely off the whack. But taking away the tax holiday, I'm not sure is going to be a big thing. so long as the corporate tax rate headline it's brought down to 25%.
Okay. I spoke to Suresh Senapati, the former CFO of Wipro, because IT will be one of the key industries that will get impacted by this. And I want to tell you what Mr. Senapati said to me. He first pointed out that there are several foreign taxes and costs that they pay that they don't get credit for in India, and therefore if exemptions are taken away, it's not a single whammy for them, it's a double whammy for them. Listen in to what Mr. Senapati had to say.
Let's say US, for example. US taxes at the state level tax on income, and that is not available under the current double taxation treaty. US tax rates are higher. That is so, but when you do a double income offset, it is only restricted to the tax rate that you pay in India and not the tax that you pay in the United States. Having said that, let us say the tax rate that you are paying in UK is perhaps at a rate lower than what you are paying in India. The offset is only the actual. So if you pool the tax that you pay in UK, the tax that you pay in US, etc., then on a pooling basis, which means on an income stream as opposed to country stream, you will find there is much more efficiency. So part of that can get addressed by making necessary amendments in income tax law. Part of that will get addressed by signing double taxation treaties. Similarly, when you talk about social security, I talked about saying when today India is doing about $100 billion of export, about $4 billion of social security taxes which is wastefully being incurred. Now, a totalization agreement can save that kind of an amount so far as Indian companies are concerned, and therefore paying a little more tax matters the least. So I'm saying there are therefore elements, and I can't in a 2 minute tell you all the items, but there are such multiple items which has to be identified and articulated, and so that the government and industry work together to be able to mitigate them.
Okay, so that's one mitigating factor. Mr. Senapati also brought up some issues with regards to the incentives for SEZs going away, even though there is a grandfathering clause that has been proposed by the government. Here's what he had to say.
Two things. Let me clarify on this one. For example, by 2017, if a developer has already put in a facility and the incentives are withdrawn, nobody is going to start a facility there because the tax incentives are no more there, and hence you will have a white elephant sitting there not being put to use. One. Two, if you think that the SEZ benefits are taken away as of today, then theoretically the hidden cost continuing to be what it is. You will find that the tax rate which the IT companies will be subjected to will be far higher than the tax rate, marginal tax rate, or the tax rate that is applicable to any company who is operating only in the domestic market. Let us assume it is 25% from 2017, and from 2017 all these SEZ tax benefits are gone, and there is nothing else that has happened in terms of superior double taxation treaties, totalization agreement having been signed, XYZ. You will find that while most companies operating in Indian domestic economy will be required to pay 25% tax, the IT companies who are operating on a global basis, or any other companies which are in global businesses and therefore generating profits outside of India, you will have a tax rate which is at least 10% more than what a marginal rate of tax in India would be. Which in other words would mean not only that you are in some form discouraging export from India, you are putting them at a disadvantage, and you are making it globally non-competitive as compared to countries like China, as compared to countries like Vietnam, countries like Philippines, and so on.
Pranav, how would you react to what the IT industry seems to be quantifying as the impact on itself?
Right, so the way I look at it is that the IT industry today probably in any case pays tax around 20 to 23%. I'm not too sure that it's significantly different from the 25% the finance minister is talking about. The points Mr. Senapati made are absolutely valid. So for example, state taxes in the US are not creditable against Indian taxes, and in any case the US tax rate is higher than the Indian tax rate. So there's a leakage of the US tax which is not creditable in India. Also, there is an absolute truth in what he says as regards the social security payments, which probably are a leakage again. Now, these are points which separately need to be negotiated with those concerned countries, and probably if those leakages stop, then it will benefit the Indian companies.
But that's a fairly long-term thing. It's not going to happen in 1 or 2 years. Let's be honest about that, right?
Absolutely true.
So if that doesn't happen for the next 3-4 years, but in the interim, the exemptions available to SEZs, and earlier there was the STPI exemption.
Right.
Since that's gone and now this will go, will it amount to a double whammy to the IT industry? Because he seems to be giving the impression that we were till now balancing the additional amounts that we were paying overseas with the fact that we were getting some sorts of exemptions here in India?
I'm not too sure. I'm not an expert in his industry as much as he is, but the way I look at it is, today most of the IT sector companies, most of their units are not enjoying tax holidays. It's a few units which are enjoying tax holidays because they are in the SEZ zone. They are also probably in that period of 5 years or to 15 years that enjoy the tax holiday. But the rest of the units are still efficient, are still operating, and are still probably making profits.
So not as much of a whammy as it sounds.
The way I'm looking at it is, it will hurt, and we have to accept that it will hurt. But at the end of the day, one will have to give up some of these incentives if we want a reduced tax rate.
I appreciate that.
Yeah,
that's what it is.
Okay,
if we do not accept that reality, I'm not too sure this entire effort is going to progress at all.
Okay, so in 2009, we, for the first time in this country, maybe 2005 as you pointed out, the Kelkar committee report, but 2009, first draft of DTC, started a debate in this country saying let's do away with all these profit-linked incentives. At that time, the thinking was let's shift to investment-linked incentives, right? The DTC has been junked, it's history. But the issue of incentives is still alive. And the ghost has come back to haunt all of you, saying, let's do away with all incentives. You say, my industry is critical. He says, his industry is critical. Suresh Senapati says, his industry is critical. V.S. Parthasarathy says, his industry is critical. Now, what does the government do?
I'm saying take away incentives.
So, you're in favor. At the end of this discussion, you're saying, take away all of them, including the infrastructure incentives.
I'm very sure about it.
I would rather go by actually incentivizing the right sectors, and potentially I'm not saying that.
Who decides the right sectors, sir? Infra is right, exports is right.
The nature of the spend is essentially, if you're going to look at innovation, which is critical for any economy, you would certainly have to look at incentivizing that. I would rather say the way to address it is to look at better compliance and expand the overall base, tax base for this country.
Okay, this is just direct tax we've been talking about. Indirect tax exemptions amount to 5 lakh crores, 4,86,452 crore rupees to be precise. So we're only talking about taking away direct tax incentives. The last time we tried doing that in 2009, it failed. That conversation went nowhere. Are we going to go somewhere this time?
I think so. I think the finance minister is serious this time. I think we'll have to be a little more pragmatic to be able to achieve this. I would feel if we are talking of creating an environment where we enhance productivity, focus on doing business rather than litigating or trying to complicate, to look at complicated tax exemptions. If we want to enhance ease of doing business, I think probably somewhere we'll have to make a beginning.
And the fact of the matter is, when it comes to indirect taxes, you're anyway going to address it through, in fact, the GST mechanism, and that's in the offering. So I'm not too sure a lot of these exemptions would stay, and once you actually have GST in its full form, then you'd know the implications.
But that's exactly the reason why I brought it up, Mr. Swaminathan, because the moment industry sees those going away because of GST and these going away because of this effort by the government, all the lobby groups within industry are going to be yelling even louder, saying, how can you do this to us at a time when the economy is not picking up?
As long as you are paying a level playing field for everybody across the sector, I think it should be fine with us.
Okay. All right, gentlemen, we're entirely at the end of our time, so I'm going to have to wrap it up here. But thank you very much to all three of you for joining us on this discussion. The final point to make here is that it will be critical to see how the finance ministry aligns the doing away of these exemptions and deductions along with the reduction in the headline rate of tax to 25%, and by that I mean a flat 25%. As yet, we've heard nothing from the finance ministry on aligning the timelines of those two. We'll see how this develops. Thank you very much for watching. We'll be back next week.